Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. Today, I'm joined again with my good friend, Doug Heagren. Hey, Doug.
Good. Yeah, again, for all of those, that's good for news for some people and bad news for others. But here I am. So good to see you, Kirk.
Glad to have you on the show. So let's kind of dive right in. And, I know we've kind of gotten into this routine of talking about themes and mental models at the beginning of the show. I kind of want to dive in and talk about some things first because I think it's pretty interesting. And actually, maybe I'll share some charts as a way to share a mental model. But I do want to start with some news. And this week we had basically a Treasury auction that no one showed up at, and that didn't go over very well. But it's funny because you see news that comes out and it says the world's ending, or no one showed up, or things are going to crash, and the market's down like 0.5% or 1%. And so I just think it's interesting that if you stand back and look, and this is really hard, right? Because we go through our life and we want news. We're like, oh, this is going on. Oh my God, I'm going crazy. And really, it's not a big problem because the news tries to whip you up and they get that fear button. They keep pressing that fear button to get you excited so you watch the news. But in reality, like things aren't always as advertised. So take the markets for instance. In the last week, or maybe it's 2 weeks now, the market spiked, but of course the weeks before that it was declining. But all in all, things have been kind of bouncing around, doing a whole lot of nothing. I mean, there's a lot of bounce, but inevitably it amounts to a whole lot of nothing. And I think what's interesting to take away from this is that many times we look at a number and we assume, oh my God, this is reflective of the situation. And we don't have what some people would call like time dilation. Like today, I think as of this moment, the S&P is up around 1%. Oh my God, everything's great. The S&P's up, everything. So if you just looked at a number and you said, hey, or the Dow, I think the Dow's up less than 1%. I think it's up 90 points. Oh my God, the Dow's up 90 points. How awesome. Well, is it? Well, if I look at the chart, it's not really done anything in the last few years. But we're having a great day, so I feel great. And if the Dow was down, I'd be like, oh, I'm having a bad day. The Dow's down. It doesn't matter. And so if you look at the concept of time dilation, it's like looking at today, and really this comes down to a mindfulness exercise. And I don't mean to be, like hippie-ish on this, but I find that in the last 10 years, what's been really fascinating, and this actually started before the show Billions came out. So any of those who've seen the show Billions, it's brilliantly written. There have definitely been some seasons which are so-so, but there have also been some brilliant seasons. And so the writing's fantastic. But if you look at that, there's some scenes in the beginning where the really the main character, Bobby Axelrod, in the beginning of the shows, he would go into a room of full quiet and he would do meditation. Now, meditation was always seen as this like hippie thing that weird people did. And now CEOs, hedge fund managers, like really high-end people are all using meditation because they're realizing, because there was basically a Harvard study and there's a book I have up here somewhere. I'll see if I can find it. But basically, there's a guy who came out, I think it was in the 70s at Harvard, and did a study of meditation and the impacts, and people just kind of dismissed it as just being, fluffy. Now people are using it. So I say this not because I want everybody to do meditation, because I struggle with doing it, and I know it's hard for some people. But basically, I mention it because some of the mindfulness aspects of it are really important. So be mindful of how you're thinking. So if you're thinking that, oh my God, I'm having a great day or I'm having a terrible day based on the market, pull it back a little bit. What did the last week do? What did the last month do? What did the last year do? What did the last 5 years, 10 years? Like what's going on with this day in perspective to everything else? So if you look at the Dow, for example, I'm just looking at a chart in the Dow, and it is pretty much the same place it was 2 years ago. So what does that mean? Just means that it didn't really do a whole lot of anything in the last 2 years. Is that good or bad? It's neither, right? Does this impact your life? Well, it shouldn't. You say, well, it's not going up means I'm not making money. Yeah, but you're not losing money too, right? And so the perspective here, I think, is really important. And I'll use this for an overlay because as we look at the markets now, they're basically trending sideways, even though there's a lot of bounce, but they're basically trading sideways. And if you look at 2000 to 2013, they also traded sideways, but there was an enormous amount of volatility. So if you look at 2000, that was the peak of the tech bubble. And if you look at 2003, I think it was, and 2009, those were the bottom of the cycle. Huge difference, 60% drop in many cases, or 70% for the NASDAQ in the early 2000s. So huge variation difference in performance and price. But over a 13-year period, they just pretty much did nothing. So having that perspective is important because it will, and this is something I find that most investors don't do, is they don't have a perspective of how they're doing in comparison to overall, comparison to other years. Just if you're looking at a relative performance, relative means your performance is relative to something else. So if you have a relative performance measure, which is what most people do, they're like, oh, I'm comparing myself to the S&P 500. I'm comparing myself to, the 10-year Treasury. I'm comparing myself to this or that or whatever. And there's a relative comparison. So if you're trying to beat the S&P, or is it relative to the S&P? If it's not if it's not close to the S&P, then it's a bad benchmark or you're doing a bad job. If you're comparing your performance in equities to bonds, you're going to have a mismatch, right? So just have some relative metric of how you're doing. Now, the title of this episode is The Bank Crisis That Everyone Saw Coming and Did Nothing. And what's fascinating to me is that we live in a time that people don't have perspective on what is going on. So this past March, about 6 months ago, we had a mini banking crisis where a handful of firms went under. We had Signature Bank, we had First Republic, and then we had Silicon Valley Bank. There might have been some more, but those are the three big ones. Those are enormous regional banks, if you will. Maybe not regional, but they're not the major banks, right? There's the major ones which are too big to fail, and then there's your local bank, and these are in the middle. So you had three very large mid-tier banks that went under. And that was a banking crisis that got stopped. And thankfully, because it could have gotten a lot worse. The reason it stopped was because basically they got bailed out. But if you think about the markets, the dynamics of why that happened have not changed. Now, part of the reason that happened is because it was run on the bank. As people said, I'm taking my money out because it's not safe. Well, if everybody does that, that basically is causing the bank to fail. So if everybody leaves their money in the bank, then the banks won't fail, generally speaking, right? But if you start taking money out of the bank, everyone runs to the bank and says, Acme Bank Corp is insolvent. Everybody runs to the bank and takes their money out, and it causes its insolvency. It's this concept of reflexivity that came from the philosopher Karl Popper, which George Soros takes and describes in a different way, which I think is really interesting. But it's a Karl Popper's philosophy, which is reflexivity, which is if you think a thing's going to happen, you can cause that thing to happen by thinking that thing. So a bank run is caused by reflexivity. You think the bank's weak, you take your money out, it causes the banks to be weak, which causes it to fail, right? Inflation is caused by people thinking there's inflation, so they spend their money now instead of saving it because it's going to be deteriorating because of inflation, so that causes inflation. Deflation's the same way. Hey, my money, we have deflation, so the best thing I do with my money is cash, because my cash doesn't lose value, but everything else does. So in deflation, you want cash. So what do people do in deflation? They hoard cash. What does that do? It causes deflation because you're not spending your money. So this concept of reflexivity happens a lot. And so what I find interesting is that frequently, for the whole history of the market, as long as I can judge, is that reflexivity has taken hold and people react according to situations. But for some odd reason, in the last year or two, not last year, but in the last year, people are taking upon themselves to not react to obvious situations. So March, the bank crisis should have just blown apart the system, but yet it stopped because money printing, other things that happen. But basically, if you look at that, now you compare it to now, right? The stock market is, depending on the index, is not at all-time highs, but it's not too far off. It's maybe 7%, 8% from all-time highs in the S&P. The NASDAQ is even probably closer. It's maybe, anyway, maybe it's about the same. Let's just say it's 7, 8% for most indexes from all-time highs. And yet, at the same time, the market is, by many metrics, the most expensive it's ever been. We have interest rates that are extremely high. People can't afford to get on debt. They're spending down their savings. Credit card debt and defaults are going through the roof. All the fundamental impacts of a really bad thing coming down the line, a big train coming, and you can't get out of the way. Like, that's inevitable given the math. Now, will it happen? I don't know. But everyone just seems to not care. In 2021, everyone, even people who don't know anything about finance, everyone knew they were going to start raising rates in 2022. Every single person knew that. And the markets didn't give two craps in 2021. Now, you'd think if you're smart, you just sell early. You'd be like, yeah, let's just sell and get ahead of this thing. Let's take some profits. But the markets are still there. And what happened? 2022 happened. And everyone rushed for the door like, oh my God, there's a fire. Well, the fire had been burning for the last 12 months. And all of a sudden people decided, oh, there's a fire. So we get into this situation where right now we have another bank crisis on the horizon. I don't know if it's going to happen. And I'm just going to be very clear. I'm not causing one. I don't know if it's going to happen. But the factors are set up so that it should happen at some point. And the factors are this, is that you have some very large banks. And I will point out, these are too big to fail banks, which means if they're too big to fail, they're not going to fail. And even if they do fail, all it means is one of the other big banks is going to gobble them up because that's all that happens. The big banks play this game of musical chairs and like, oh, well, we can't fail. So, we'll bring in, it seems to me, JP Morgan is the bank to bring in to bail out other banks because it's happened so many times. Oh, JP Morgan, hey, would you mind taking over this other big bank that is failing and will bring down the entire financial system? Sure, I'll buy it for pennies on the dollar. Sure thing, JP, buy it up. It seems like this game of government monopoly that's going on, a game of monopoly behind closed doors in the government. Like, yeah, let's just, the big keep getting bigger and we'll have one bank and then whatever. It's a big problem. But the point being is you have this bank crisis everyone sees, and there's one, I'm not going to name because I don't want to cause a bank crisis, but there's one big, large bank, one of the biggest, that is, let's say, on the precipice of failure. And it will fail if people start pulling their money out because their bond portfolio is a complete disaster. They've lost a huge amount of money. We may even mention it in the show, but I don't really, like I said, I don't want to be the contributor of a financial crisis. So there's a big bank and they're on the precipice of failure, and they could hobble along for the next 10 years for all I know, because it's not, their portfolio is a disaster and they can't fix it as long as rates are high. So as long as they stay stable until the Fed starts lowering rates, then they'll be fine. But if we start having a bank run on them, or that we go into a massive recession and they keep rates high, which is a very possible scenario, then this bank is inevitably going to be screwed. Or if we go into recession and people they run out of money and they start pulling their bank accounts, that's going to be a problem too. So I just bring this up because people don't seem to care about these black swans on the horizon. And maybe, and this is the point of my whole story, the big long rant to come up to this point is, maybe the problem isn't that people don't see it. Maybe the problem is because we've created a financial system based on moral hazard. Now, moral hazard means that if, think of it this way. If you have a banking crisis, so 2008, right, what happened? You have a banking crisis, but there are some banks that are just too big to fail. So because they're too big to fail, people say, well, I can take a ton of risk. AIG is a perfect example, AAA rated company. Because of their AAA rating, they made boatloads of money by doing stupid things, by selling basically call options on their company for pennies, pennies on the dollar because they had a AAA rating. Well, what ended up happening is all of those stupid moves they did caused the company to effectively, I don't want to say they went bankrupt because they went through the reorg system, but basically their company was defunct, more or less, even though they're operating. They killed their company. And so what happened? Well, they're too big to fail. So they didn't fail. Like I said, GE was in the same boat. They're kind of too big to fail, and they should have gone bankrupt, but they didn't because General Electric, it's a blue chip, and we can't let that happen. So a lot of this shenanigans that go on behind the scenes, these too big to fail institutions, they're a problem. They're causing moral hazard. And what happens is you say, well, I'm too big to fail. I can take more risk. So the problem isn't that they're too big to fail. The problem is people know they're too big to fail, so they take a boatload of risk because they know they'll get bailed out if they do something stupid. So the moral hazard risk causes bigger problems. Oh, you're going to get bailed out. Let's take more risk. More risk creates more problems. More problems create more problems. So it's just because we bail out stupidity, it causes more stupidity. So that's where we are in the banking system once again, for different reasons than 2008. It has nothing to do with real estate. It does, but not for the same reasons that it was before. This is basically their treasury portfolio that they've screwed up. So long way to say we have a moral hazard problem. It's getting worse every single year. And at some point, I don't know where that some point is, the system kind of falls apart because we are slowly eroding the support pillars of the system.
This is a public service announcement. Hi, my name is Kirk Chisholm, and I'm with the government, and I'm here to help. Doesn't that sound reassuring? Well, let's talk about how they're helping. The government needs your help to make our money worthless again. PPP loans, student loan forgiveness, helicopter money. Let's keep the party going until our money is totally worthless. Don't think it can happen? Sure it can. Just ask Zimbabwe, Venezuela, Greece, Germany, Hungary, Greece, Yugoslavia. Did I say Greece? As a loyal listener to the show, I want to give you free money. I'm giving away free money in one of these hyperinflationary currencies. Go to www.moneytreepodcast.com/free money and follow the instructions to get your free gift. I have a large audience and only a limited supply of these currencies. I'm not the Federal Reserve, so I will run out at some point. Make sure you get yours before I run out. Go to moneytreepodcast.com/free money. Follow the instructions and get your free money today.
So I went at my diatribe. Doug, what do you got to say? We got a lot of news to cover, a lot of points, but what are your thoughts?
Yeah, I think on that one, I think the thing that I want to touch on so we can have time to get into the other stuff is coming back to that moral hazard. It's not, it can be on a micro level, like you were talking about with GE, or I think a great example is taking a look at a company like AIG and what happened, what happened after the great financial crisis. It was too big to fail. You see this all the time. I think you see this moral hazard occur. I think a lot of times the way our system is built around fining or penalties for committing crimes. Let's go back and take a look at, if anybody's on Netflix right now and has been watching, as what I've been watching, as I guess, is it Painkiller? I think it's the one on the crisis for OxyContin, right? And you take a look at what happened there, right? They basically, could argue that they created here I go, Kirk, a heroin cartel, right? through the pharmaceutical, through the legal pharmaceutical channels. And they got to the point where they basically violated all of the systems that were in place in the way that they could go about marketing these, marketing and controlling the distribution of these pills to the public. And at the end of the day, what happened, right? They basically, they basically were put in a situation where there was going to be potentially a significant legal, if not criminal charges against them. It got swept under the rug. Yes, there were some lawsuits that put him into bankruptcy, but the family's still worth $13 billion, right? So what was the what was the moral hazard there? Literally, they could take this risk of violating significant laws that were in place on pharmaceuticals And at the end of the day, they were bailed out of having to take any culpability from that. AIG, same thing. So we see this time and time again. And now I want to take this to a macro level on the stock market. Have we gotten to a point, Kirk? It's a good question to ask. If that, I think two things could be possibly coming as a takeaway from that. First of all, you mentioned that do we really even care? And I think that we have to ask ourselves, are we to the point in which there is just so much noise, so much information, so much data, and so much volatility? And we talk about volatility versus risk all the time. So much volatility out there that we've created this moral hazard, this belief that no matter what we do, the market will come back, right? It'll bounce around. Buy the dip is a perfect example of moral hazard. It's, you know what, no matter what I do, if I just keep saving every month, don't worry. Yes, the market dipped. Great. It went down. I bought it cheaper and it's going to come right back. Forgetting that we've gone through significant cycles of dead returns, right? We talk a lot about 2000 to 2013, where you didn't make money during these periods. As a matter of fact, you could have lost tremendous dollars during these periods, especially if you take a look at what happened with the dot-com implosion. Now we take a look at what has happened, at least, and now we're talking the older that we get, the older that all generations get, whether it's the baby boomers, Gen X, the millennials, Gen Y, Gen Z. We're starting to get to a point where some of these generations have never actually experienced seeing that crisis occur. And why is that? Because every single time there is a risk of something going wrong, the government has stepped up, at least in recent history, and injected QE, or like with the potential bank failures of 12 to 18 months ago. They stepped up, they made some deals that all of a sudden said, all right, I know we've got these reserve requirements and I know you're supposed to have this liquidity, but you know what? You didn't have it. That's okay. We're going to create another system to just give you that liquidity. So we're going to fix that problem. Every single time that this excessive risk taking could lead to a potential in which, there could be an efficient market type of reset. People have lived an entire generation now where they have seen the government or other forces come in, not allowing those things to reset, bailing it out, and we move along. And so you have people that have forgotten, that have become completely apathetical to this, but you've also had people that have grown up never actually experiencing this. And then now you look at what's the impact of that? An inability to be able to make decisions to minimize risk because of the moral hazard of believing that is all going to work itself out. And I think that, and we're in a very, very, say this time it's different. This part of it is unusual. Okay. I'm not going to say it's different, but it's unusual in the course of history because it is the application of multiple different types of fiscal and economic policy, all crashing into each other in a way in which the outcome of that is something I think we've never truly, at least those living, have never seen.
All right, well, let's dive into a few things here. I'm going to share some charts because I think it's always helpful to kind of show some things. I talked about relative performance, and I wanted to kind of point this out, and I can show a few of these. But if you're looking at relative performance, right? So this is a chart of, is this the relative performance chart, Doug, or is this the?
No, this is the actual performance of the small caps in comparison.
Okay. All right.
Right now.
So this is the performance of the Russell 2000, which are basically small cap stocks. Okay, for the last 22 years. Okay, not so great. Some good years, some not. Now here's a chart of let's see, relative. This isn't relative.
Well, the small cap one that you just showed, the key takeaway there, and in terms of how the stock market has really separated, small cap stocks, what it was showing is are now underperforming the S&P 500 for the largest margin since September 2001. So in 23 years, that divergence between the S&P and small cap stocks is as big as we've seen in over 20 years. So that's what that was relating to.
All right. So I guess the point is one of the interesting things is we're talking about relative performance. typically in normal times, and I'll just kind of impart this lesson, we'll move on. In normal times, most equity markets move in a similar manner, right? So the point of diversification is to find non-correlated assets. So there are times when some assets do well and some won't. Growth will do well, value will not. Value do well, growth will not. Large caps or small caps. So there's all this relative performance, which is really important, and that's the point of diversification. Now, one of the problems in our system is that the relative nature of the different asset classes are no longer working properly, would be the best way to say it. Now, if you look at different asset classes, and I'm not sure if this one, I don't know what you put up here, but if you look at one of those periodic tables, and anyone's ever seen this, financial institutions have them all the time. It shows every year, it's like a bag of Skittles, there's different colors, and you can track the performance in each one. And what you'll notice over history is that there's no real theme, right? So one year real estate does well, next year it doesn't. Large cap does well and doesn't. And there's a lot of this back and forth. Oddly enough, I haven't seen a lot of those charts recently, in part because there's not as much difference. The best place you had to be was mega cap growth stocks. If you were in those, you were great. If you weren't, then you underperformed significantly. So if you look at something like, and I always look at this, there's a bunch of equal weight indexes out there. And so I'm going to name one, not that I'm saying you should invest in it, but just for reference. If you look at something like the RSP, which is the Invesco Exchange Traded Fund, equal weight S&P 500. Now, if you look at something like this, as of this year, it is performing negative. So as of today, it is negative 2%. There was a time where it was actually, I think a week ago, where it was around negative 7% for the year. Wow, that's pretty bad. You compare that to the S&P, which was, it's up like 10% or something like that. So the point of that is instructive to say that, well, we look at the S&P as the index because it's the index, right? But is it the right index? Well, if you compare the performance of the S&P of, let's say it's 10% to negative like 7%, that's a 17% spread. But it's the same thing. But it's not. It's not the same thing. The difference is in the percentage allocated from certain equities. So the RSP is 500 stocks, each one having 1/500th of the performance. Now the S&P 500 doesn't have that. There are, I think, 5 or 7 stocks that have 25% of the performance of the index. Well, you know what those 5 or 7 stocks are, right? They're basically the FANG stocks or the Magnificent Seven or whatever people are calling them now. Those stocks make up most of the performance. And we talked about this in an earlier show and how if you look at those stocks, they're up like 55% this year. Now, last year they were down a lot. So in comparison, it's not really fair. But they're up 55%, which is why you get this 17% spread. Now, does that mean that the S&P 500 is wrong? No, it's just an index. Does it mean the RSP is wrong? No, it's just you're using them for comparison to see what's going on under the hood, right? I'm not saying one is good or bad, or it doesn't matter. Like some people say, well, I should only have the RSP because it's equal weight. That's fine, but people are going to compare it to the S&P. So, what goal are you trying to accomplish? So I'm not saying one's better than the other. My point is that in comparison, it should tell you something. It should tell you that there's something wrong here. This 17% spread there's something wrong here, and isn't that interesting? Let me look further. So one of the factors that is really important is this performance in the index due to a handful of stocks, or is it due to all stocks? Now, if you have a broad-based upside, so if you have like 500 stocks, let's say you have 400 of the 500 stocks are going up, that's a good sign. That's what we call breadth, like breadth of the performance. So if all the stocks or most of the stocks greater than 50% are going up, that's a good thing. But if you only have like 10% of the stocks going up and the rest are not, that's not a good thing. That's what we call unhealthy versus healthy. If you only have a handful of stocks driving the returns, that's unhealthy. If you have a lot of stocks driving returns, that's healthy. So the performance could be the same, but one is a healthy performance, one is unhealthy. The reason I bring this up is because the healthy performance is what you want to pay attention to, right? That's good. That's when you want to feel confident that the market's going to go up. When you have unhealthy performance, that's when you have to say, you know what? I'm going to step aside here. I'll let the mindless traders trade this, and I'm going to stay out of the way because I just don't have a lot of confidence where the market is here. And we've been seeing that time and again for the last few years that the market doesn't have a whole lot of confidence in as a whole in the indexes. There's some pockets of greatness and there's some pockets of terrible performance. The NASDAQ is a good indicator of this because there's a lot of performance coming from a handful of stocks and a bad performance coming from the rest. So I would say just be mindful of how this works. I do want to raise one thing because I saw this one chart, and I'm going to give it back to Doug here. I'm going to share this chart. So this chart is the world's top 10 biggest polluters of CO2 emissions in 2021. Now let's assume the numbers are accurate, which I never do when it comes to any sort of climate-related stuff. Well, let's assume they're accurate. What should this tell you? Well, China accounted for a third of the CO2 emissions. Okay. So what does that mean? Does that mean China's a polluter? Well, I guess it depends if you're counting CO2 as pollution. Pollution, I actually argue, is a different term, but CO2 emissions. Okay, is that a good or bad thing? Well, I don't know. It depends. What are you doing? If you're comparing it to Indonesia, which has a fewer number of people and less industry, you could say, okay, well, it makes sense, right? The U.S. has more industry and has more people. China has a lot more people than everybody and has a lot more industry, especially since everyone's outsourced the manufacturing to them over the last 30 years. Now, India is interesting because India has a very similarly large population, not as much industry. There's more intellectual capital or service-based. So I just raise this because people look at this and say, "Oh, China, they're terrible. They're terrible people. They're polluting and they're destroying the world with global warming and all the other stuff." I say, well, you have to ask yourself why. Like, if these numbers are accurate, which you should always check, you should always doubt numbers, statistics, and the like. You should always double check the work that someone else has done because frequently it's not correct. But let's look at this and just say, why is this number this way? Is there a reason? Is it because they want to pollute? No, I don't think China wants to pollute the world. I don't think they want to kill their people, which they are doing with pollution in their own cities. It's a real big problem. They don't want that. They're not saying, well, let's kill our own people. Like no one thinks that way. And if you think they do, then it means that you have to you have to readjust your thinking. It's like Republicans saying, well, Democrats really want to destroy the country. No, they don't want to destroy the country. They just have a different way of solving the same problem that you're trying to solve. And Democrats have the same problem. Well, Republicans just want to kill everybody. And they're heartless. No, they're not heartless. They just have a different way of approaching the problem than you do. So I raise this because when we look at this, we naturally think, well, this is an anti-China thing. Well, it might be because things frequently are at this time. But, Germany is known for heavy industry, and it's 1.8, but they have a smaller population. So you always want to ask yourself, well, why is this number so high? It's not because they desire to have more pollution. Is it because they have more industry than other people? Maybe. I have to look at the statistics. I mean, I know they have a lot, but in comparison, I don't know. So it's just an open question. When you say the world's 10 biggest polluters. Now, when you see the top 10 biggest polluters is let's just say it's a manipulative word because it says polluters to get your attention, but underneath it said CO2 emissions. Now, some people consider that pollution. I consider CO2 CO2. Pollution is pollution, right? If you're billowing like smog up in the air and your people can't breathe, or you're poisoning the waters, like that's pollution, right? CO2, I'm not going to get in that debate. But the point being is, just by reading this, I feel like I'm being manipulated. I feel like pollution, because it gets people fired up because no one likes pollution. B, because China, it's so much, it's what, almost 2.5 times the pollution of the US, which people argue the US is bad, but, it's 2.5 times the US. Okay. So you got people fired up about China, is basically what this says. That to me, it feels like I'm being manipulated to get mad at China for their pollution. Now, this could be 100% accurate, but what's the point of this? That they're polluting? I don't know. Like we already know that they have a lot of problems with the air quality. So what is this trying to convey? This isn't surprising me at all. And so I'm not defending it. I'm just saying that I see stuff like this every day and it just makes me laugh. I'm like, well, there's another bit of manipulation, deliberate or unintended, but either way, manipulation. So I just wanted to point that out. Doug, what do you want to talk about? We got a bunch of charts here to share. I got another good one. You want to talk about the Treasury holdings, because that gets into the Fed auction.
Yeah. Let's take a look at yeah. So obviously, sorry, just trying to shift my thoughts here on a couple of things because I had some charts that were kind of going on with what you were saying. But obviously, so here's what's going on with the Treasury auction. So as you mentioned of yesterday, what part of what was going on is the Treasury auction was posted yesterday. There was a lot of pessimism going into the morning as to what was going to be the effect of the Treasury auction, and would there be anybody stepping up who would be, willing to bid on those auctions. And you can see here, that the Federal Reserve, in China has not been buying the U.S. Treasuries. They've been declining they've been selling off the number of U.S. Treasuries that they've been holding on to for a significant number of years. The U.S. government is going out there trying to auction off these to buyers, and right now the global world is in a Treasury selling mode, right? So supply and demand. It's the same thing you're dealing with anything else. Is if everybody is stepping up and trying to sell these things off to get out of them, and for the same reasons we talked about with the banks, right? If you are holding something that is no longer going to be as lucrative for you to be able to hold on to. Now, there's a couple of things. There's going to be the interest rate that you're going to earn off of it, and then there's going to be the trust in the factor of the liquidity of, is that now a safe investment as compared to everything else? And for a long time, Kirk, this, the U.S. Treasuries were considered to be a safe haven. It's where everybody, across the globals look to say, look, we can put money there. We can buy the Treasury. The U.S. government is going to go ahead. They're going to feel free to pay us on this. And we believe that they're going to be good for that debt. Okay. But we've seen a massive spike in the issuance of debt and the deficit of the U.S. government over the last couple of years. That's no surprise to anybody. Okay, you take that along with you take that into consideration with also what's going on in the internal economies of the rest of the global world. And one of those we've talked about ad nauseum is that China has been slow to come out of the slowdown of COVID. So they've got a lot of their own internal issues right now they've been facing. My daughter right now is actually doing a significant study in her global in her global geography class of talking about just some of the impacts that China has been facing from the implementation of the one-child policy and what that has led to. And they have a significant increase in the rising age of their population. And they've also seen that there's been that has created an effect on the workforce, because not only is it older, but you've also got a decline in the motivation of the younger population that leads to an effect on the development of new industry, the development of entrepreneurialism. Yes, they're communists, but they do have an entrepreneurial base that they have designed, which is why they've created these businesses that have done the manufacturing. Going back to the global emissions, they have been part of a massive industrial revolution, right? And so from that, now, as they are facing a softening in their own economy, one of the places that China has taken a lot of their wealth and bought up is U.S. Treasuries. Those U.S. Treasuries now, as we all know, with the rise of interest rates from the Federal Reserve, have now led to the biggest decline in U.S. Treasury values, calculated in history. So when the federal government is going out there and issuing this new debt. Now, the new debt is coming out at higher interest rates, but there's also you start to look at the balance sheet of the U.S. government. You start to look at the softening of economies in other parts of the world. You're starting to see a significant decline in the interest of buying up U.S. debt. Okay, and we're starting to see that selling pressure of China, of their own deleveraging of that, along with this increase in the federal government trying to issue new debt. The timing of this is ominous, and that's why leading up into yesterday's auction, there was a significant pessimism that there was going to be enough people showing up to buy treasuries and to buy this treasury auction. And what happened yesterday, and why there was certainly a dip in the market yesterday, is the fact is that that came true. There were not enough people coming and offering a supply or a demand against the supply of those treasury auctions that were being put out there. And Kirk, do you have any thoughts on that?
Yeah, there's something I actually want to convey here is that, we can look at this a few different ways, right? And ultimately, if you look at history, right, and this doesn't go back far enough, but if you look at history, the U.S. has issued an enormous amount of debt over time. Now, being the global reserve currency naturally puts a depressive power on the currency, and inflation is almost required. So our global power comes at a cost. This is the cost, is that we in some ways support the global economy, and it causes an inflationary effect in the US. Now, over time, it can't last forever, because being the global reserve currency, every single other country eventually deteriorated because of this, and it's just a slow erosion of the economic stability of the country. In simple terms, what's happened in the last 30 years is we outsourced a lot of our labor to China. If you can get somebody for $10 a day versus $10 an hour, why wouldn't you outsource it to China? So China went from this backwater country with billions of people to a superpower because we outsourced all of our labor there. They took that and they turned around and reinvested it, and their people excelled. And now in many ways, they're ahead of the US. Not every way, but in many ways they are. And we got to a place where we realized, we created this big problem. We created a competitor, effectively. We created a potential adversary, which could, cause global problems. But effectively what happened was we outsourced, we gave them wealth, and we kept running up debt. But China was taking our debt because, I can't sit behind the scenes and say what happened, but effectively, hey, we're gonna push stuff to you, and you have to buy our treasuries. Because the U.S. always had a little power. Well, you have to buy our treasuries in exchange for this, which means that it wasn't just us doing it. Like Japan, most of the Japanese debt is held by the Japanese citizens, so it's self-funded, right? So if people want to bankrupt their own country, they're doing that to themselves, and no one else is going to buy it, but they can support themselves. But if they had to go out and sell it to the market, I don't want to own Japanese debt. Eventually that's going to be worthless. So with the Fed, what's happening here is China has slowed down their purchasing. So a lot of people, I think it was about 10 years ago, I heard some interviews with some really smart people who said they wargamed China. And they brought in some economic theorists, they brought in some military people, they brought in all sorts of experts from all parts, and the Pentagon did a war game, right? And it wasn't just a military war, right? Because that's one part. You could have an economic war, you could have a cyber war, and the point was they got these teams together, like a red team and a blue team, and they virtually fought it out, right? And they said, all right, you're Team China, you're Team US. How would you do this? And they ran many, many scenarios. And they came up with some pretty cool stuff, some of which I heard. Some they're not supposed to come out, but some people talked about it. And anyway, some people came out and said, well, all they have to do is dump all their treasuries. Like, yeah, that sounds good in theory, but not reality, because if they dump all their treasuries, it means they're taking a bath. They might as well just light their own money on fire. Because if they have like trillions of dollars in treasury, or billions of dollars, or I guess in this case trillions, 5.5 trillion at the peak of treasuries, and they dump them all, well, who's going to buy them? Well, nobody buys them. It drives the price down and drives the yield way up. But at some point, somebody's going to say, yeah, I'll buy them, like 15%. Sure, give me those. So there is a point, and so stupidly, you can't assume that they're going to dump them to attack us, because who cares? Somebody will buy them. I will buy them. 15%, I will buy 15% treasuries today. So it's not a great strategy. It's an interesting thought, but not a great strategy. So China's smart enough not to do that. But it doesn't mean they have to buy more. So you look at this, the holdings have slowly declined. Well, all they have to do is just not, when they come due, they get paid back and they just don't buy more. So eventually their portfolio disappears over time naturally. And for them, that's probably okay, because they don't lose money. Now, if they're not buying, who is? And this is a big problem. And this is where the US can get themselves into trouble. If China's not buying, well, who is? Well, I don't know. We didn't actually pull up this chart. So I can't share that with you this week. We'll have to get that chart. But if you look across the globe, different countries buy treasuries for different reasons. Our allies buy them. Many countries buy them. Institutions buy them. Retail investors buy them. So, it's gotten to a point where you have 5.5% treasury yields. I'm buying them, right? Why not? It's a good yield. It's not a great yield, but it's good enough. I would love 10. I'd love 15. I'd love 20. But 5.5 is pretty good for today. So, if China's not buying, other people have to, which means that if we have a 0% treasury rate, no one wants to buy them. So what happens? Well, if nobody's going to buy it, it means that the price has to go down. Well, if the price goes down, it means the yield goes up, right? So instead of 0, now it's at 1, 2, 3, 4, 5. So the price is dropping and the yield's going up. So now we got 5, right? And so over time, eventually you get to a point where people are like, yeah, that's a good price. I'll buy that. And they have to take over the amount of purchasers, the new auction. So Doug talked about the auction this week. So the new auction comes out. Hey, we were issuing new treasuries. Somebody buy them. Oh, nobody wants to buy them. Oh, crap. So now the yield goes up, right? Because eventually it goes high enough. If you put the yield at 100%, someone's going to buy them. I mean, I'll borrow from loan sharks at 30, so I get 100%. I mean, realistically, it's the government, so you have to weigh that risk. But the point being is that there's a point where people will buy. But all that means is the rates will rise until we reach that point. And once they reach that point, you will have enough buyers. And we might not be at that point today. And that's the point of where we're going with this. And that's the mental model you need to understand, is how that supply and demand works with treasuries, that there's always going to be a buyer, and it might just be the people or the government, but we don't know where that point is until the auctions happen, and the auctions are what dictate that yield.
And Kirk, let me add one quick thing on that. So a lot of this was around the 30-year Treasury bond, as we've already talked about, has been absolutely decimated based on the rise of interest rates from the Federal Reserve. There was really bad timing because the Federal Reserve Chair, Jerome Powell, surprise, surprise, suggested the U.S. Central Bank may not be done hiking interest rates just yet. So when you think about these long-term treasuries, we talked about these banks that are sitting on these long-term treasuries, right? You just talked about. You can't just go out and dump them all, because they take a bath, massive losses. Why we don't want to see, and certainly the banks don't want to see, a massive run on those banks, because as long as they can sit on them, it doesn't matter what they're worth. It's if they have to sell them that they then lock in those sales, which, again, from anybody listening to this on financial planning, this is exactly what you think about when you've got your own investment portfolios and you think about how to build that diversification between different kind of asset classes. And I'm not just talking large cap versus small cap. I'm talking about cash. I'm talking about other things, because if the economy hit the skids and your portfolio drops by 50%, listen, we all talked about this. Eventually it should come back. But how long can you wait? Long as you don't have to wait on it, as long as you don't have to sell it, well, then that's not going to be a big problem. But if all of a sudden you have to liquidate it out of fear or the need for liquidity, Now you sell it at 50% declines. It's like basically being a farmer that had a bad year with locusts. And now what you have to do, instead of eating the corn, you've got to go dig up the seeds. And if you dig up the seeds, the corn's not growing back. So when they looked at this and they said, look, we got these 30-year bonds and they're paying less than short-term bonds are now, nobody wants them. But like you just said, Kirk, there's going to come a point where people will be willing to pay. And what happened is it basically drove the U.S. yields up on those when those bond prices fall. The U.S. yields rose and they stopped at a high of about 4.6769%. That's meaningless to the listeners, but it's higher than what the market expected at the bid deadline, and it was about 5 basis points, a 5 basis point miss, the largest miss since August 2011. Okay, so really, really poor metrics. And then when we talk about China, there's another chart that we've got. Probably won't get into it today, but Mexican imports just exceeded China for the first time in years, right? And a lot of that we've talked about too. When one of the things that was a challenge for China coming out of COVID and getting things restarted, a lot of it had to do with their extended COVID policies and lockdowns. A lot of importers said, look, this has been great. It's been wonderful working with you, but now we can't get what we need. But we know what we can do. We can drive it right up from the south of the border through NAFTA. And guess what? That could be temporary. But if you take a look at that trend already starting prior to COVID, right, you can see that there was a dip in Chinese imports that, wasn't just COVID. It was starting here looking back as early as 2017, 2018. And of course, it plummeted during COVID. It started to rise again, but we've seen it dip even further, as there could be a number of reasons for that. But what has been steadily increasing since 2006, although there was a dip there, of course, economics occurred in the early 2000s, Mexico and the signing of NAFTA probably correlated to a lot of that. Correlation, causation, again, don't have enough data to show exactly, although you can guess. We started to see a continual increase in the amount of imports we're getting. And it's not one-to-one. If you look at how big China has dipped compared to the rise of Mexico, there's a lot more data to this to say, hey, it all just shifted south. But you can see that bump, that spike since 2022 there. Again, I think this is going to be something you're going to see a little bit more of a realization of. We want our goods. We've had a significant problem getting those goods. There's been an absolute bullwhip effect on being able to, on the supply chain. And guess what? If that means that trying to get that stuff across sea, which has historically been cheaper to ship by sea than say by land or other means, if the value add of the actual pricing of shipping those things no longer combined with the ease of getting them exceeds the true cost of getting it elsewhere, that's what happens. Manufacturers, companies, they shift, because at the end of the day, you can't sell what you don't have available.
That's true, and we're definitely going to start to see some changes in that chart. I mean, if you look, that I would attribute that decline in imports from China to be the Trump effect. In his second year in office, he really started to go hard at China, and rightly or wrongly, COVID, other things. It's just the nature of the direction that we're going. And I think even though Trump's not in office now, the direction is sound. It's going. It's not going to reverse.
As soon as he made those changes, the companies had to adjust to it, right? And once you adjust to it, that's where you start to go from then on. You're not going to go, oh, it's over. Let's reshift our business model again.
Right, and it's not even Trump that is the he was the one that exacerbated the change, but the change was already sitting there, and I think he started because people were frustrated with what China's doing, and they decided, we're just gonna go this route. So, that die is cast and not coming back. I wanted to have one more chart, and we're going to wrap it up here for the week. This just gets into what we were talking about before. So this is basically tech versus the S&P 500. So what's interesting here is if you look at tech is at all-time highs versus the S&P 500, and this is just relative. So basically, it just shows that tech is just blowing the doors off of every other stock. And does that make it right or wrong? No, it just means that you need to be aware that this is happening. Tech is becoming an increasing part of our economy, an important part of our economy. And, as you kind of look at this, you have to realize, like, all right, do I need to put more in tech, or is this a bubble? And this chart leads you to believe that we're in a bubble. And in many ways we are. But is it only tech? No, it's everything. It's an everything bubble. But I would argue that tech is becoming an increasing part of our economy. So I think that the new equilibrium is no longer that dotted line. I think now the equilibrium, you have to ignore the 20s to like the 70s because we didn't have a lot of tech. So it's not really a fair comparison. I think the comparison is probably the new comparison is probably that dotted line and the top solid line. I think is probably more of the range that you should be aware of. Now we're still at the top end of the range, but I think the argument is, if I look at a chart, I'd say, well, why are you showing me like 1926? Like, what do we have for tech in 1926? I don't even know. Maybe we did. Maybe the printing press was tech in 1926. I don't know. I don't know what they characterized as tech. So for me, it's kind of this chart is a little bit of a mess in terms of the data, but still, like I would look at this and say, all right, well, when did we have really tech? Tech is really the last 40 plus years. But let's just look at this chart realistically and say, all right, we're probably looking at a new range rather than this being an extreme end. Now, I do think we are at the extreme end of the range, but we're not. I think tech could certainly get higher. But right now, everything's expensive, and I think assets across the board are expensive, and everyone just needs to be careful. So, Doug, where can people find more about you as we wrap it up here?
Well, and I will say there is some history. The Morgan Stanley and some others have put out that correlates market volatility to the reaching of standard deviation extensions. So once you get past 2, it starts to get a little bit more risky, and once you get to 3, there's been some incredible data notes on how the markets tend to react to that. So the fact that tech is sitting there, bouncing around that 2 standard deviation, I think certainly leaves a lot to watch when you start to sit there and say, okay, is there risk in the markets? Well, there's always risk in the markets. Is that risk now possibly a little bit more, apt to be sparked? I think, be cautious. That's all, I think that's all that shows. Yeah, thanks, Kirk. So, again, one thing we didn't get into today is debt. And we've talked about that on a number of weeks. It's going up. There's a lot more pressure, in terms of auto debt, home debt, credit card debt, and of course, student loan debt. If you want to find out if you've got kids that are going to be going to college in the next 3 to 4 years, what you need to do is you need to get the numbers. And we've got the new key data for the numbers of 2023, 2024. That is out now. So you want to look at what the costs of college have come to, what you need to know before you go. Find out. You can actually get that new data from us. I don't know if we've got it posted on our website yet, but if you want to get the numbers to start making really smart decisions with your money, who doesn't want to do that? Especially around paying for college. This is a massive cost. It is more than you think. And so is the process that you're going to have to go through. Talk to anybody who's gone through it, the applications, the money. It's overwhelming. Make it easier on yourself. And we have some great resources. Check out ProCollegePlanners.com or feel free to email us at info@ProCollegePlanners.com. We'd be happy to get you the new numbers just so that you can have some really valuable information. No expectations, no cost to you.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.